I'd argue today is the worst time to just straight buy real estate at market values because what's the most basic rule in investing? Buy low, sell high. What does that mean in real estate terms outside of what sort of local maxima and minima are? Well, cap rate. Look at cap rate. Or in the residential market, gross rent multiplier. So a relatively high value is when cap rates are at their lowest, which is right now. A relatively low value is when cap rates are at their highest. So you want to buy when cap rates are high and sell when cap rates are low. Now cap rates are as low as ever. Now's the time to sell. Now's not the time to buy. And a lot of people get confused by that, particularly developers, because they just want to ride trends. And the problem is they're always jumping on the bandwagon a little bit too late, especially when you've got a long lead time investment, like a building project that requires permits and extensive construction. Now, you can still structure very profitable and safe transactions in real estate, but it's typically not done by just a straight acquisition. There's some sort of value add component. There's some mining to be done to identify specific holes in the market that allow for a real discount where there's a disconnect, there's an inefficiency between market value and price, which can happen in private markets. But just buying something in a market that everybody in the market knows about is probably not a good idea.
What would be the alternative if you would say, I want to do something in real estate, but it's not buy and hold right now?
In terms of a systematic approach, instead of buying a property, you could become a lender. And because what you can do as a lender is you can set your basis, you can set your LTV. So you can say right now, the market is at a peak, the property is worth $1 million, let's say, keep the math easy. But when cap rates go up, when cap rates were at their highest, this property would be worth half of what it is right now. So as a lender, I'm going to say, I don't want to be in this property for $1 million. I want to be in this property for what it would be worth at a market bottom, which is about what the highest historical cap rate tells you. So let's say it's $1 million today and it's a 5% cap rate, but the highest cap rate you ever saw was a 10% cap rate. That means it could potentially lose half its value, not adjusting for inflation. So you don't want to be in at $1 million. You want to be at $500,000. You can't buy anything at half price just because you want to. So how do you do that? No, you can't buy it at $500,000, but there's nothing stopping you from lending $500,000 as a first lien holder, as a first mortgage lender. And then if they need more money, then you just bring in somebody else to be a second mortgage lender. And there are plenty of people out there happy to do that and go up to a 70, 80% LTV. Let them take that higher level risk at 50 to 80% LTV. And you're in an effectively risk-free position from 0 to 50% LTV because you've got a 50% equity cushion. The property can fall in value as it approaches the highest historical cap rate if that were to happen. So no matter what happens, you're safe. And if they default, you're the first mortgage holder, you take the property back and you can sell it at whatever. And taking it one step further, going a little further in the weeds, people tend to think that real estate's illiquid. It's really not illiquid. The reason people believe it's illiquid is because in a falling market, people get appraisals that utilize historical comps that are 6 months, a year old, and they use the highest comps they can find to try to justify the value they want. And they're shocked that nobody wants to pay that. Well, in a falling market, of course, it's worth less today than it was 6 months or a year ago, especially if you're looking at comps that were the highest priced ones. So if you price it properly, if you take into account like auctions and flash sales and you discount 10% to that, that's what it's really worth. And it will sell within 45 days, no matter what.
The argument that you just made is basically every asset is liquid as long as you're okay with the price that you can get today.
Now, in real estate, they might take a week to get title pulled and whatnot.
Yeah, of course, you put money in escrow, and the process is a little bit longer than.
And so a week instead of a day, but it's not that much more illiquid. And what people fail to acknowledge is that it doesn't really matter.
I think that's a good final statement to head into the weekend.
Indeed. Good to see you, Dan.
Yeah, thank you, guys.